Welcome to the Investing Ahead podcast. I'm Tom Curran, co-CEO and founder of Curran Wealth Management. Hello, I'm Tom Curran, and welcome to Investing Ahead podcast. Today I have Derek Gray with me, who's been an employee of ours, part of Curran Wealth Management for the last 7 years.
8 years.
8 years.
Going on 8 years.
Okay, I'm
now.
a little bit off. Derek, why don't you introduce yourself and tell the people a little bit about what you do on a day-to-day basis with us.
Thanks, Tom. Again, I'm Derek Gray, Vice President of Private Wealth Management at Curran Wealth Management. As Tom said, I've been there for about 8 years. I've been at some other financial firms over my career, which is now over 20 years. And my main focus at Curran is to work with our clients in a relationship management capacity, but also to focus on our clients' overall financial well-being. We try to offer our services as comprehensive as we can and offer anything that could be of specific benefit to making their financial lives better.
Derek, tell me, in all the years you've been in our business in financial planning, financial services, what do you think is the most difficult thing we confront in dealing with trying to help younger clients?
Well, a number of things come to mind, but I think number one, younger clients don't have the investment experience to understand the long-term power of compounding. I think it's a slow burn sometimes, and there's ups and downs. And if you're doing the wrong type of investing, like penny stocks or something like that, it can turn a younger person off to investing and say, this isn't worth it. I'd rather spend the money. But with the right type of investing, and that's our challenge. We need to tell them that with the right type of investing, not necessarily swinging for the fences, but having good results over a long-term time period is really where the compounding comes in, and it's very powerful in terms of growing their wealth in the long term.
Yeah, let's talk a little bit about that. I think it's useful for everyone to think in terms of the rule of 72. If we look at stock market returns over a long period of time, going all the way back to prior to the Great Depression, we know that the average rate of return, not annual rate of return, but the average rate of return is 10%. At 10%, your money doubles every 7 years. At 3%, it takes more than 20 years. And that's a very powerful component when you're looking at the lifetime of a 21-year-old, 22-year-old worker. I don't think that's really understood. I think the other thing that's not understood is the inflation rate. So that if a 21-year-old is playing it safe and accepting a 3 or 4% return over their lifetime, in my lifetime, my working lifetime, the average rate of inflation has been 4.1%. 4.1%, which means looking back on my lifetime, I didn't really earn any real money until I earned more than 4.1%. And so sometimes the risk-averse characteristics that a lot of people have, yes, they may lose money in a year. They may even have a bad 2-year period. But once we lengthen those time periods out to 5 years or more, we know that you're going to begin to zero in on that 10% rate of return. So in looking at that, I'd like you to talk a little bit, Derek, about how we think. I mean, we know that we think in the present sense. So you take a 22-year-old who's in the workplace, and maybe his first job, maybe he's making $50,000, maybe he's making $70,000. But it's probably somewhere between $50,000 to $70,000. Now, when he's 65, I'd kind of put this in front of you and ask younger people to think this way. If you look at the current workforce and you look at your current position, where would you expect to be? Where would you expect to be in 10 years or perhaps at the end of your career? And let's just say that person who's starting out at 70 is looking at a salary of 175. He has to think not in terms of 50. He has to think in terms of 175 influenced by inflation, which
Right.
might be 350 or 400 by the time he gets or she gets to retirement age. So with that kind of a backdrop, let's talk a little bit more about investing now, like we like to say, investing ahead. Uh, do you think the average 22 or 25 or even 30-year-old or perhaps even 35-year-old thinks in those terms?
No, I don't. I think the past 2 decades, we've had low inflation, and the past 4 decades, we've had declining inflation. So I think a lot of younger people have are going to have some trouble, with this concept of real rate of return. And we see it all the time in our day-to-day dealings with clients in terms of focusing on nominal rates. A 6-month treasury bill is 5%. Doesn't that sound great? Well, it sounds great if inflation's 1%, perhaps. But if inflation is 4%, well, the real rate of return on top of inflation becomes 1%. That doesn't sound great at all. I don't think younger people think about things in terms of a real rate of return. They think in the present time, they think of nominal rates of return, and that can be problematic. I think part of the planning that we do with our clients involves assumptions, and retirement planning specifically involves assumptions that would include how much they think their expenses are going to be. In the case of a younger person, sometimes 20 years, 30 years down the road. It's a very difficult task to tell me what your expense. I can't tell you what my expenses are going to be next year, let alone 20 years from now. But we can make assumptions, and hopefully we make conservative assumptions and err on the side of caution. And we grow that expense amount in the present terms with inflation, maybe 3.5%, maybe 4%. And we can see what the outcomes are based on varying the sequence of returns. So sometimes your portfolio has a good start with the period that we're analyzing. Sometimes it's a bad start, and everything in the middle. And we can kind of assess how many times in these different simulations a client may run out of money based on a certain sequence of returns, and we call that a probability of success ultimately. So that's how we can get our clients to start thinking in terms of inflation and future expenses is with exercises like that.
As you were speaking, Derek, it occurred to me that typically when we do a retirement income projection, I think most of the time people we do that for probably 50 or older, probably closer to 60. That is, the way it works, it seems like we're doing that at early to late in the pre-retirement. Late in the pre-retirement planning. I wonder if we should start doing that for 25-year-olds. And, and run that number. It's going to be horrifying, but maybe we should be doing that to give younger people an idea of what they really need to do. Unless they have a fair amount of money, it won't look pretty, but maybe it'll be a more realistic way. What do you think of that? We don't do it now, but maybe we should routinely do that for all our younger clients.
I think there's things to consider with younger clients. Number one, we used to say garbage in, garbage out with an analysis like that. So if you're giving me bad assumptions, you're telling me you're going to need $5,000 a month for your expenses, and you actually need $10,000 inflation adjusted per month, well, then this exercise isn't going to be very helpful. So it's important that we focus on good assumptions. But one of the problematic items that can arise with younger clients and running that type of analysis is the higher end. I've seen clients get fixated on this higher end because what we're varying, we're keeping the cash flow parameters consistent throughout the analysis with inflation adjustments and things like that. But the real variance is the sequence of returns. So in some cases, you have the best sequence of returns. And over a 40, 50, we usually say 95 or age 100, in terms of life expectancy. So if you have a 20-year-old and we're running it to 100, that's 80 years. And the best sequence of returns is an astronomical number. And a younger client may say, oh, I'm going to have $150 million by the time I'm 95 or 100. And it's a bit head in the clouds. So in those situations, it's a throwaway number. Anything close to that is going to be great. I like to focus on the median and then a little bit on the low end. Well, how many of the bad sequence of returns simulations are we facing, which is essentially suggesting that you might run out of money before your life expectancy. So I try to turn the focus to the median and the lower end. With the high end, hey, that's great. It's a little head in the clouds. Let's not focus on that.
Okay. I want to go back to something you said earlier. When you use the example of a T-bill rate, a treasury bill rate of 5%, but perhaps coming in a environment where the inflation rate is 4%, meaning a 1% real return adjusted for inflation. What that means is if at 1%, it would take 72 years to get the same purchasing power that we have today. In 72 years, you'll need a purchasing power that's going to be many, many, many times greater than a 1% annual real return. It's got to be at least 4, 3.5, 3% at least, just to keep pace with inflation today. So I wanted to go back to that because that's one of the problems that younger people have. They need to adjust for inflation. I don't think even people who are much older really do that. We have a tendency to look at the price of almost anything in today's terms and say, wow, everything's going up in price, but not necessarily planning for it. I like to say that when I started out, and I've said this a number of times, I had a goal when I was quite young in my early 20s to have $1 million at my age 65. I thought that was a lot of money. It was a lot of money in 1969, 1970. It was a lot of money. Today, to have the same purchasing power that I visioned at 1 million today, it would have to be nearly $8 million to have the same purchasing power. So if we go back, I'm asking everybody to think in these terms because it's the only way to think if you're not going to get terribly fooled. So in 1970, starting salaries for most college graduates came in at around $5,000, some higher, some lower, but $5,000 to $6,000 was a real good number. So back then, $1 million would produce at 5%, $50,000. Let's just say a multiple of 10 times the average starting salary of a college graduate in 1969, 70. So if we do the same number today, pick a number for an average starting salary. I'd say that number is around $10 million. Mm-hmm. So if you tried to do the same exercise today, well, you needed $1 million back then to do, you'd need $10 million today to come up with enough income to cover the starting salary for an average college graduate. So this whole idea of needing a whole lot more, always needing a whole lot more in the future than you need right now, becomes imperative. When we're 65, 70, yes, prices can go up, but at least they're limited to a life expectancy. Let's talk a little bit about life expectancy too. Back when I visualized that $1 million at age 65 and what it would buy, my life expectancy was about a year or two beyond age 65. Let's go back to Social Security. When Social Security was signed into law in the 30s, the average life expectancy was about 2 months beyond full retirement age at 65. So not only do younger people have to confront the inflation, the savings and investment challenges, they need their money to last a lot longer. So today, when we sit down and talk to a 65-year-old couple, and we're talking to them in terms of one of them living to perhaps as long as 90.
Mm-hmm.
I think I've read that a 20-year-old, 30-year-old healthy, when they sit down to have that same conversation, they're going to be looking at probabilities closer to 100. So when you stop and think about full retirement age at 65 or expected or hoped for retirement, it's a lot of years to go without ever getting a pay raise, without ever getting a paycheck, without ever getting a bonus. It's a long time.
Mm-hmm.
So how do we help our clients face that?
It's challenging. Social Security, especially. A lot of the IRA required minimum distributions, things like that, have been adjusted for longer life expectancies. It's hard to do that for Social Security. I think it's been done once, 65 to 67 on a sliding scale. That's probably going to slide older. But you're basically, the politicians have to tell Americans that your retirement age just increased. So don't think about retiring at 65. How about 70? So that's a tough thing to do. But the challenge of living longer, and by the way, Social Security um, was kind of originally, the actuarial calculations and things were based on life expectancies at that time. Like you said, maybe a couple of years after age 65. One funny story with the first recipient of Social Security was a woman named Ida May, and she put in, I think, less than $10 into the Social Security system, and she ended up living a long life, well into her 80s, and collected thousands of dollars from the Social Security system. So that's some of the challenge. And when I work with clients, in some cases, I've had clients tell me, don't assume that I'm going to get any Social Security, and I want to plan that way to be more conservative. As a default, I do include Social Security. I think there will be changes to it, but hopefully, with clients that are more on the cusp of retirement, they'll be somewhat grandfathered in to how the benefits work now. But for younger people, I think much more is going to rely on their own personal savings. And there are a lot of investment vehicles out there that benefit younger people with a long time to invest. Roth IRAs, for example. It's a way for young people who aren't in the highest or peak tax brackets that they're going to be in their career. It's a way to put money without an immediate tax benefit, but a deferred tax benefit where they'll never have to pay taxes on that bucket of money again. So I like Roth IRAs, or Roth 401ks is a newer way to contribute to a lot of 401k plans, make that available. And it gets the taxes out of the way, but it also ends up with a bucket of money upon retirement that you get to spend every dollar. There's no taxes due. You don't have to account for taxes. So if you have $1 million in a Roth IRA, you can spend $1 million of that money. And that's sometimes reassuring when we think about our tax system and potential changes, and if our government will need more money in the future than it does now. There are vehicles that can be very beneficial to younger clients that they're starting their accumulation phase or in the middle of their accumulation phase as well.
Derek, As you were speaking, it occurred to me that discipline is a big part of being a successful investor. I think discipline is so much more important than intelligence, cleverness. Discipline to hang in there, invest for the long run is incredibly difficult. Now, when you mention Roth IRAs, one of the things that occurs to me from time to time is that right now, a traditional IRA, because it's subject to taxes when we take it out, people tend to be thrifty because they don't want to pay taxes on that IRA withdrawal. There's no requirement to be thrifty with a Roth IRA. There is no tax. You think that could be a problem if as Roth IRAs accumulations grow over time, that without that tax man taking a big chunk of whatever we get in our traditional IRAs, it's free money in a sense. Do you think that could be a problem?
It could. It could. I like the element of tax diversification that it offers, because if you're saving in an employer-sponsored plan, even if you're doing a Roth type of contribution to that plan, your employer's putting money in via match or a safe harbor profit-sharing contribution. And that's always going to be treated like the traditional IRA. I mean, it's taxable upon distribution. So you're probably going to have an element of that, even if you focus 100% on Roth type contributions. When I think about withdrawals in retirement, I think often about sustainable withdrawals. Also apply that to tax buckets. So I don't want you to take 10% from your Roth IRA and 2% from your traditional IRA. I'd rather you took 4% from each and can sustain that, so you can continue to have the benefits of tax diversification, where if something comes up, you can access more money, but manage your taxes to, I don't want to go into the 32% tax bracket, or if I have $1,000 more of income, my Medicare premium is going to increase. So there's a lot of benefits to having that type of tax diversification. To answer your question, I think with the right help, people like us, I think we can manage that to not just raid the tax-free money, but there could be an incentive to doing so.
Yeah.
As I need more money, I don't want to pay more taxes. I could see people going to that.
Derek, tell me what you believe younger people need. I happen to believe in, when I wrote my book, Investing Ahead, so many people who read that told me, I want my grandsons, granddaughters to read this. I want my children to read this. And I think it's so very important that people today understand that the rules have changed. When Social Security was written into law, there were 44 people working for every retiree. Last year, that number went lower than 3. It's about 2.8 workers for every beneficiary. And it's expected to continue to slowly go lower. So what I enjoyed certainly can't be sustained. We tripled the tax rate. We took the base on which Social Security was being charged from roughly $6,000 or $7,000 to $168,000. We can't do that. If we do that again, Social Security will wind up being taxed at 40, 50%. It's already almost 30% of the federal budget when you count in Medicare. So whether we like it or not, it's not conceivable. It's not sustainable that these things continue as they have continued. So I look at our greatest challenge is to reach and find that magic formula that allows younger people to understand that no matter what we've done in the past, while it would be everyone's goal to be able to continue that into the future, we need to tell a much different story to help our younger population. So I don't know whether you share that challenge or not, Derek. I'm not sure that anyone else does either. But for me, as an almost 80-year-old, it's a primary goal for me before I finally hang things up and move on from a lifetime career in financial services.
Yes, and I think of it in your book. You talk about the definition of wealth or being wealthy, and I think that's what younger individuals, they need to think in those terms. And it doesn't mean having a lot of money, right? It means financial freedom. It means, I think your definition is something along the lines of having enough to support your desired lifestyle without having to work another day in your life. That isn't on top of mind with a 25-year-old or even a 35-year-old. They're going to get up, going to go to work, going to make money, going to pay the bills. Then all of a sudden you're 45, then you're 55, then you're 65, and it becomes more important. But if you think in those terms now, I wish I could have a conversation with my 20-year-old self about investing.
Right.
And you mentioned discipline earlier as well. That's a big part of it. You're going to see, your own version of the dot-com bubble bursting, the financial crisis, the pandemic drop. 2022, was a bear market. Every client, every investor is going to see their own version of that. And if you weather the storm, you can see, and we have seen it, it's going to be profitable for you, and it's going to help you with your goal of wealth and financial freedom in the long run. So that's the story I think we have to help our younger clients with, understanding that. How they get there takes discipline, and it's not straight up. There'll be some volatility, but we know what the stock market does in the long term, and we need to harness that power.
Thank you, Derek. Thank you for joining us today on the Investing Ahead podcast with Tom Curran. Thank you for listening.